Ray Dalio just validated the most alarming bubble warning in America. Jeremy Grantham calls this the biggest investment bubble in American history. And Dalio's answer was simple. In effect, he is right. That should get your attention, because Dalio is not some casino bear. He built Bridgewater from a two-bedroom apartment in 1975. Over time, Bridgewater's investors gained roughly $53 billion net. Then came 2008, when stocks crashed nearly 40%. Bridgewater still made 9.5% that year. So when Dalio maps cause and effect, not vibes, it is worth listening. A bubble is simple. Prices soar, stories glow, then everything snaps. 1929 and 2000 followed that same dangerous script. It usually starts with a genuinely revolutionary technology. People look at it and say, this is unbelievable. It has to win. Then they buy, borrow, and stop caring about the price they paid. AI feels identical. Revolutionary, exciting, and suddenly price blind. But here is the machine underneath the mania. Wealth is not cash until you actually sell something. Paper gains cannot buy dinner. They cannot pay down debt. When taxes or higher rates demand cash, the selling begins. Falling prices then flip that leverage machine in the opposite direction. On the way up, rising collateral supports bigger and bigger loans. On the way down, debt forces urgent sales. And when one person spends less, somebody else's income falls. That is how a market bust can become a recession. The 1920s were dazzling. They were not stupid. Electricity, refrigerators, cars, planes, and radio really did change everyday life. People were right about the future. They were wrong about the price. Profit simply could not support all that borrowed optimism. And the unwind helped ignite the Great Depression. Now picture one giant AI stock marked at $100. You borrow $50 against that paper wealth. Then a shock hits, and everyone needs cash at the same time. The price drops to $25 before you can get out. You still owe $50. At that point, you are insolvent. Multiply that panic across an economy, and spending freezes. Dalio says this process comes close to being mechanically inevitable. Meanwhile, nobody in AI knows future revenue precisely. Underinvest and competitors can bury you. Overinvest and the returns may stay unknowable. In fact, a tiny sale can manufacture a huge valuation. Raise $50 million and price the company at $1 billion. On paper, the founder just became a billionaire instantly. But nobody actually paid $1 billion for the whole company. And shares are not spendable until they are converted into cash. Often rates rise exactly when optimism looks safest. Now zoom out. Bubbles sit inside a much bigger cycle. Wealth gaps widen, and political rage grows on the left and the right. Downturns push neighbors to blame neighbors. Governments run huge deficits and ask, where is the money? Britain changed prime ministers in 6 of 7 years. When taxes climb, capital and rich people can leave. Compromise dies, and politics starts amplifying economics. Geopolitics also shifts when dominant powers stop setting the global order. Money, debt, domestic conflict, and foreign conflict all converge. Dalio calls that convergence the big cycle. On average, it lasts roughly 80 years across a lifetime. The last major turn arrived around 1945. America and Britain now look late cycle. Most people see the headlines. They miss the hidden machine underneath. That means AI mania becomes one stress test inside debt, politics, and geopolitics. And what usually pricks a bubble is a sudden demand for cash. Higher interest rates are the classic trigger. A wealth tax can also force investors to sell. Tighter money makes bonds compete more directly with stocks. Then supply can flood the market through endless new share issuance. Companies can issue stock almost as easily as they make promises. Hot demand meets new supply. Then forced sellers arrive. Dalio says classic bubble signs are already visible. But bubbles come in degrees. They are not simply yes or no. The key is watching whether assets sit with strong hands or weak hands. Weak hands are inexperienced buyers using borrowed money. Leveraged ETFs can turn investing into casino betting. When fear collides with margin calls, the machine reverses hard. Do not try to predict the exact day. Respect the fragility instead. For regular people, this stops being theoretical very quickly. Imagine you are 30 and have $100 spare each month. Your main asset is you, plus limited help from the government. So raise your own market value before chasing the perfect portfolio. AI and machines are moving from replacing muscles to replacing minds. Productivity can rise while pay gaps widen at the same time. If you cannot reach the top 10%, your options narrow. The answer is finding a skill that makes your time worth more. That might mean driving Uber or deploying AI for employers. Either way, you still need income. In the best case, love and work become the same thing. But never romance your way past rent. The same ability can get wildly different prices in different arenas. You can drive strangers, or you can drive Ray Dalio. Both are driving, but one market pays far more. Across art, furniture, clothing, and labor, the top commands the premium. Sometimes 10% more skill can double the reward. So choose the right pond, then become rarer inside it. This is not motivational syrup. It is survival math. Machines will keep compressing ordinary human uniqueness. Scarce skill, placed correctly, is your remaining moat. Cycles will not bend for effort, but buffers still matter. Use boring risk rules. Diversify. Count your runway. Build safety. The winners are not always the smartest or the hardest working. They are the most adaptable when causality changes. Bubbles break. Cycles turn. Technology keeps moving forward. Your edge is understanding cause, adapting faster, and staying solvent. So what would you do with $100 each month? Build skill, pay debt, or buy stocks? This content is for educational purposes only.